More money making. Today I want to talk about pension plans other than the state pension and workplace pensions. How much you can and should be contributing and the tax implications. So, what if you want to make extra contributions beyond the minimum to get the maximum employer contribution? You may decide you want to put extra money away, either for the tax purposes described later, or if you don't think you'll have enough saved by your planned retirement date. Your provider will typically give an estimate of what your pot will be able to buy when you retire, but this will be greatly affected by investment returns. The further you are away from retirement, the more of an estimate these figures will be. You have a couple of options in terms of extra contributions. You can contribute more into your workplace pension if you're happy with the investment options available within that, or you can open up a personal pension account such as a stakeholder pension or a self-invested personal pension or SIP. I'll talk about personal pensions in another video. They're also often used by people who are not working, self-employed, their company doesn't offer a workplace scheme, or they're not eligible to join it for whatever reason. Now let's talk a bit more about pensions and tax. As mentioned in the previous video, pension contributions are made from your pre-tax income, so you benefit from tax relief added by the government with a percentage governed by what rate of income tax you would have paid on that income. There's a way to get even more tax relief by using something called salary sacrifice, if your employer offers it. This is a scheme where you give up some of your monthly earnings and they put it directly into your pension. This means that as well as the tax benefits mentioned previously, you'll also save the national insurance you would have paid on that income. Your employer will also pay less employer's national insurance, which gives them an incentive to operate the scheme. You may even be able to negotiate with your employer to receive some of this employer benefit. With salary sacrifice, bear in mind that this could reduce your earnings, so you'd no longer qualify for certain benefits like statutory maternity pay, job seekers allowance, and employment and support allowance. When you eventually come to draw down on your pension, you can take up to 25% of it tax-free. With your remaining pension pot, you can then use it to buy a guaranteed income called an annuity for the rest of your life. Or, you can leave it invested in the stock market and take an income from it as it hopefully grows in value, which is known as drawdown. The annuity gives you a fixed, guaranteed income, whereas drawdown will vary depending on the performance of your investments. I discuss annuity versus drawdown in detail in another video. Withdrawals beyond the initial 25% are classed as income and taxed in the same way as if you earn this income while working. Normally, your income will be lower in retirement than while working, so by saving tax on the way in and paying it when you draw your pension, you're often making a sizable tax saving. For example, if you were a basic rate taxpayer while working, you save 20% income tax on any pension contributions. If in retirement your total pension income is lower than the basic rate threshold, then you pay no income tax. So you effectively save 20% tax here. Similarly, if you are a higher rate taxpayer while working, you save 40% income tax on any pension contributions. If in retirement your total pension income is lower than the higher rate tax threshold, then you pay 20% income tax. So again, you effectively save 20% tax. Now let's talk about how much you can and should be contributing towards your pension. The earlier you commit to investing for the future, the better position you're likely to be in later life due to investment growth and compounding returns. So, what's the maximum you can contribute? There's technically no limit as to how much you can put into a pension, but there are limits on how much tax relief you'll get for doing so. Each year, you can get tax relief on contributions up to 100% of your earnings, but capped at £40,000. There is also something called carry forward, which basically allows you to make use of any annual allowance you may not have used during the 3 previous tax years. In terms of overall pot, there is a lifetime allowance, or LTA, which is currently just over £1 million. This is more important than the annual limits, since a tax charge applies if it's exceeded, the details of which we won't go into here. With the annual limits, there is no penalty, you just won't get any more tax relief. Note that for all these allowances, money paid in by someone else, such as your employer, counts towards these allowances. So, how much should you be contributing? Many people believe they will rely on a state pension as their main form of regular income when they retire. But that may not be enough on its own, and if the eligibility age continues to rise, then many will find themselves working long after they plan to. Many media commentators have also questioned whether the state pension will even exist in its current form 20 years from now, with some suggesting it could be means tested in the future. Therefore, a workplace pension or personal pension is a very important consideration. With auto-enrollment workplace pensions, there are minimum contribution levels. But if you can afford it, you really should be contributing more. There's a very rough rule of thumb for what to contribute for a comfortable retirement. Take the age you start contributing to your pension and halve it. Then put this percentage of your pre-tax salary into your pension each year until you retire. So someone starting age 32 should contribute 16% of their salary for the rest of their working life. This may seem like a huge commitment, but this includes your employer's contribution. This is just a rule of thumb though, so you should review your contributions regularly, using the forecast available in your pension statement and thinking about your specific income required in retirement. If you're quite frugal, you may need less, whereas you may need to save more for a more lavish retirement. The advantage of focusing on saving into a personal or workplace pension is there's the possibility of retiring before the state pension age, which is currently 66, but set to rise to 68 by 2046 at the latest, and may even rise beyond that in the future. You can choose to retire before this, using money saved in your personal or workplace pension, which will usually allow access to your pot 10 years before the state pension age, but check your pension scheme rules. To retire even earlier than this, it's necessary to invest within something called a stocks and shares ISA. I discuss ISAs versus pensions in a separate video. One final option for extra contributions worth mentioning is a lifetime ISA. A lifetime ISA can be used to save for a property purchase as well as for retirement. Open to those aged between 18 and 39, it allows savers to stash away up to £4,000 each year, after which they'll get a 25% top-up from the government. The bonus is paid until the saver turns 50, and under current rules, the money can't be accessed until they're 60, unless it's to buy a first home or they're diagnosed with a terminal illness. This can make them a decent option for saving for retirement for those who are self-employed and therefore don't benefit from employer contributions. Ordinarily, though, they are at best only as good as pensions, but with a later access date. Its 25% bonus is effectively almost the same as a basic rate taxpayer's 20% tax relief. For higher rate or additional rate taxpayers, the tax relief is lower than the 40% and 45% income tax saving offered for workplace and personal pension contributions. Thank you so much for watching. I really appreciate it. Please add your own thoughts and follow-up questions in the comments, and I'll try to get through as many as I can. If you made it to the very end, please destroy the like and subscribe buttons and notification bell so you never miss a chance for more money making.